doing some trading here. Phil's President, Chief Investment Officer at Palumbo Wealth Management. Good morning, Phil. Banks have been a rock. Can that hold up?
Good morning, Oliver. I do, yeah. So for me, I like to keep it as simple as possible, right? For me, it's the deregulation, tax reforms, and the pickup in M&A activity due to economic strength that will continue. And that's really going to be the backrock behind actual banks continue to accelerate and perform well. In addition to that, as interest rates ought to move up higher, you're seeing improvements in net interest margins. As we know, that's a big part of the profitability of banks. And loan growth, we've seen a slowing over the past couple of years for obvious reasons. Rates up, loan growth has slowed. We believe that there'll be a pickup in that area there, which will be contributed to the bottom line profits of many of these banks.
Okay. The bond market's been kind of going wild again, but it seems like this time around we've got more growth expectations, so a little bit more palatable for the banks.
But is it growth expectations, right? So that's the big question. And my number one concern as I think about equity markets in general. But the long end, is it going up because of economic strength? And yes, the economy surely is growing. And now with the Trump administrative win and pro-economic policies, rates going up because of that, I do think that does make sense, right? So Greenspan used to say, tell me where the 10-year is going or is, and I'll tell you where the economy is going. So with rates rising, it does tell you the economy is strengthening. But you do have to ask yourself, is it because also of the deficits that we're running right now? And no matter what candidate won, and obviously it's Trump, the question is, nobody talked about how to fix the deficit. So are rates rising truly because of the economy or because of the deficits? And that's something that we all have to think about. So as rates do continue to rise, which I do believe will continue to happen, as long as truly economic strength, then the banks will continue to do well.
Okay. JP Morgan up another percent. It's like going inverse to the market today. Pretty impressive stuff. Thinking about what potential for growth there is it necessary to see that? They obviously picked up a lot of assets in the regional bank stress from yesteryear. Do we need any more of that, or do you think we're kind of smooth sailing?
I think JP Morgan is positioned from a standpoint of strength relative to their competitors. And you think about it, for any business that we invest in that's public, it's all about management. It's 50% of the equation or greater. And we all know that Jamie Dimon is one of the best leaders out there. Look what he's done. Looking during the financial crisis, there are limitations on mortgage debt that caused a lot of banks to blow up. Their exposure was very, very low. So he does a great job from a risk management standpoint, and that's really how you run a bank. And you take it even further than that, you think about from an investment banking standpoint, they're the preeminent leaders in investment banking and credit cards, consumer banking and savings. So they're so dominant in when it comes to banking. So from an investment standpoint, we're really comfortable owning JP Morgan, as we do feel that financials will continue this run that we're seeing based on what I talked about before.
All right. Well argued. Chart doesn't disagree. Been a rock, been solid. Hang with us, Phil. I want to talk about the rest of the market too. Tom, when you look at the banks, look at JPM, are the options calm? Is it a cheap place to own volatility, to own upside directionally, or how do you approach it?
I'd be a little bit more cautious here at this point, just because it's already run up over 42% so far.
We're trading like a safety trade right now.
Yeah, it is a little bit, but there's strategies out there that you can take advantage of. Maybe owning the shares, collecting some yield, maybe a paid-to-wait type strategy if you think that 248 all-time high is going to hold, where it's not going to maybe go that much farther above it. So I looked at a cover call strategy here, Oliver, where I'm going to, for every 100 shares of stock that you buy, you're going to sell some upside call against it. I went to the 250 strike out in the December monthly options, so 35 days to expiration. That's a couple bucks above the all-time high, as I mentioned. So for every 100 shares of stock you buy, you sell one of the December 20th monthly 250 strike call. You're paying roughly about a debit of $239.70. It might be a little bit higher than that. But the debit that you pay is going to be your break even. So you're buying the shares, you're buying them at a discount because you're selling that upside call against your long shares, which creates some yield. And then because you own the shares, you get to keep, get a hold of that dividend, that 2% dividend yield that gets paid out on
That's what you want.
Yeah, so maybe that's what you want. It's a paid-to-wait type of strategy. You still own the shares, right? Mm-hmm. And then as you get closer to expiration, you can roll that short call on a week-to-week or month-to-month basis. That allows you to collect credits. That lowers your break-even. That increases your potential profitability on this type of trade. So maybe a paid-to-wait type of strategy where neutral to bullish in nature, but you're still owning the shares.
Okay. I like that approach because, I mean, that is one of the main, value props of owning the financials, and the bigger ones too is the shareholder friendly, the dividend, the payout. So fair enough. All right. You still get, long exposure, but collect a little income along the way. Fair enough. All right. When we get into the second half of earnings, what excites you, Phil? As we've seen some of the tech stuff struggle a little bit. Our heroic semiconductor trade has gone sideways now for weeks. Do we get the software trade to make up for it?
I do think we do. We see that. So with the AI movement that we're seeing, the first investments are the hardware, the build out of the data centers, right, and the chips that we've seen. And the second part of it is really the longer term part of this is the software part of it, right? So take Adobe, for example. Adobe's a business that we're looking at investing in right now. That they're a leader in the digital media space. I mean, everything right now is about content creation when it comes to marketing. And one of the biggest players is Adobe. And so for them, and you really think about the whole business, I mean, free cash flow is $5 to $6 billion, anticipated to be more going forward. They're growing top line revenue. I could see 11% on average in the next 5 years. Their reinvestment of capital is exemplary when you think about the returns of around 20% plus. So software players like Adobe that's taking and adopting AI into the business and going to increase sales as a result of that. And plus Adobe has recurring revenue is 95% of the business. I mean, so businesses that are adopting that, like Palantir is another example, these are businesses that will thrive as a result of AI.
Okay. Like that thought, because some of these programs are pretty amazing what they're already doing. It really gets the creative juices flowing. It seems like a place early on where the AI power kind of teams up with the human ingenuity. So we'll see, though. It hasn't quite played out on the chart just yet, and Adobe's still getting hit. Phil, thanks for the thoughts.
Thank you, Oliver.